Hi, I am Mahendri Naidu, a solicitor at Moore Kingston Smith in the private client legal department. Today, I'd like to talk to you briefly about executors' duties. Being nominated as an executor in someone's will is indeed a great honour. However, with the role comes much legal and personal responsibilities that you should be aware of. Just briefly today, I'd like to look at what the definition of an executor is, what your responsibilities are, as well as any legal implications that could arise for incorrect administration. And finally, I'd like to end with some initial steps you should consider when you are appointed as an executor. What is meant by the term executor? Well, you'll often hear the term executor or administrator, or even personal representatives. Simply, an executor is someone who is named in a will. An administrator is where you are appointed on an intestacy, so there's no will in place. And the term personal representative is used to refer to both executors and administrators. However, for the purpose of this discussion, I will refer or to the role as executor, but it will apply to you whether you are an executor or an administrator. Know that if you are an executor of an estate, you become legally entitled to deal with the administration of the deceased estate. So, in effect, you step into the shoes of the deceased and should be able to manage all assets and liabilities of the deceased. Your responsibilities can be divided into three parts: legal, tax, and administration. Firstly, looking at the legal responsibilities, you need to apply for the grant of probate. You need to interpret the will of the deceased, or understand who the beneficiaries are in terms of the intestacy that arises if there's no will. You need to identify and deal with any valid claims against the estate. Generally, a deceased should make provision for those that he's personally responsible for, and a failure to do so can allow those aggrieved beneficiaries to bring a claim against the estate for support. So you need to be able to deal with any valid claims against the estate if this arises, or even claims by creditors of the estate. From the tax point of view, you need to report the estate for inheritance tax, income tax, and capital gains tax. Remember that any inheritance tax has to be paid within 6 months of date of death. A failure to do so will render penalties and interests against the unpaid tax. And if the delay is due to any fault of yours, you could be personally liable for the interest and penalties. From an administrative point of view, you need to manage the assets in the estate. You need to ensure that the asset holders are notified timelessly in the timely fashion of the deceased death. You need to settle any debts and claims by creditors as soon as the grant of probate is received and you have access to the funds in the estate. So remember, even though you have time in which to settle the debts and can show that you don't have access to funds, interest will be charged from the date of death on any unpaid claims against the estate. You also need to ensure that you're able to account to the beneficiaries of the estate by running what we call an estate account, showing the assets in the estate, liabilities in the estate, as well as any income generated in the estate. It's crucial to get everything right, because if you fail to do so, you can be legally and personally responsible. So failure to take hold of the assets in the estate, delays with the administration, where you can show no good cause for the delays, can hold you personally responsible. And your hard-earned assets could be used to pay off any claims by the beneficiaries. Also remember that this is a role for life, although in theory an estate administration can take up to a year. If there's a trust that arises out of the will of the deceased, you could be appointed as a trustee of the will and assume the role of trustee. Also, there are instances that I've seen where assets have arisen a few years after the estate administration was wrapped up. So in this instance, you would need to deal with those assets. So in a sense, your role as an executor is revived whenever instances like this occur. Remember that claims by aggrieved beneficiaries can be made within 6 months of date of the grant of probate. If a beneficiary can show good reason as to why the application against the estate was brought out of time, you would need to consider that application made by the beneficiary. Also remember that some creditors have up until 12 years in which to claim repayment of any unpaid debt. So you need to ensure that you have the proper indemnities in place before you distribute an estate. Because if you pay out an estate and later a claim comes to your attention, you would need to settle the claim, and if you've already distributed the estate, you would have to do so from your personal funds and then have recourse against the beneficiaries for this money. And if a beneficiary has already spent their inheritance, then you are at risk of having to pay this out of your own pocket. So some initial steps on your appointment. Firstly, interpret and understand the provisions of the will. So identify who the beneficiaries are, know what entitlement each beneficiary has received from under the terms of the will, or what their entitlements are as a result of the intestacy that arises if there's no will. Secure all assets as soon as possible. Very important if there's an immovable property in the estate. Make sure you notify the insurers that the deceased has died and that the property is unoccupied, so that the insurers can make the required amendments to the policy. Failure to do so could mean that should there be damage on the property, the insurers reserve the right to refuse payment on the claim, which would mean once again you could be held personally liable for not reporting the death on time. Also note the timeframes and requirements for each stage. If you can show no good cause as to why there have been delays with the estate, any losses to the estate or losses to the beneficiaries could mean that you would have to be, you'd have to compensate the beneficiaries. So once again, having to access your own assets to settle these claims. Always act impartially, especially if you're also a beneficiary of the estate. If this occurs, you in effect wear two hats, one as your role as an executor and one as that of the beneficiary. So you need to ensure that any decision you make as an executor benefits the entire estate, as well as all the beneficiaries of the estate and not just yourself. And seek professional help if you're unsure of your role or duty. Remember that professionals have the competence and expertise to deal with estates. They also have professional indemnities that they can rely on if there's any incorrect administration of the estate. So you have some comfort and reassurance that if something goes wrong with the administration of the estate, you can call on these professionals to make good on any claims brought by the beneficiaries. Thank you. I hope you found this useful. Please feel free to contact us should you have any queries about your role or unsure of anything relating to your role as an executor. Thank you.
Hi there, my name's Claire Roberts and I'm part of the private client tax team here at Kingston Smith. And today I want to talk to you about the tax obligations associated with being an executor. So an executor has many responsibilities as they have a legal duty to ensure that the estate of the deceased is administered properly. So this involves collecting in the assets of the estate, paying the estate debts and distributing the assets. So clearly tax plays a big part of this role. And as an executor can be held financially liable for any loss resulting from a breach of their duty, it is important to get this right. And this is even the case if a mistake is made in good faith. So once the immediate steps are taken care of, such as registering the death and arranging the funeral, the next thing to deal with is the inheritance tax, which, depending on the nature and complexity of the estate, can take some time. The inheritance tax liability depends on the value of the estate at the date of death. So the first step is to value the deceased assets and liabilities. So for assets like cash and quoted shares, this should be relatively easy to do. However, if the deceased held property, unquoted shares, or business interests, part of this process will involve obtaining professional valuations. Once the estate has been valued and the inheritance tax has been calculated, the inheritance tax account should be delivered to HMRC on form IHT 400 and the tax paid. Now, the IHT 400 is due for filing within 12 months from the end of the month of death. However, the inheritance tax is payable 6 months after the end of the month of death. So it is advisable to complete and submit the account as early as possible. And clearly, it's crucial that the inheritance tax account is completed accurately, as HMRC can charge penalties for errors. And as I said earlier, the executors can be personally liable for these penalties. So payment is due 6 months after the end of the month of death, and interest will be charged by HMRC on any unpaid inheritance tax from this date. The grant of probate also cannot be obtained until the inheritance tax has been paid. Now, without probate, most of the deceased assets cannot be realised, so the executors will need to make sure that the banks are prepared to release funds to pay any tax to HMRC. And if that's not possible, there is the option of paying the inheritance tax on London property in 10 annual instalments. Alternatively, the executor can borrow funds or make the tax payment out of their own funds and then be later reimbursed from the estate at a later date. So dealing with the deceased tax liability to the date of death is the responsibility of the executor. So in many cases, this will mean that self-assessment tax return to the date of death is required. For instance, where the deceased was self-employed, had rental income, foreign income, or had capital gains. One thing to be aware of is that any chargeable event gains arising on the life insurance policies held by the deceased may also need to be reported on the tax return to the date of death. And this will typically be the case where the policies are not written into trust. The normal filing and payment deadlines apply, so that's 31st of January, following the end of the tax year. In practical terms, if there is a delay in obtaining probate, it may not be possible to pay the tax by the due date. And where this is the case, HMRC should only charge late payment interest from 30 days from the date of grant of probate, and any late payment penalties should be cancelled. If there are any earlier years tax returns which are outstanding, these would also need to be completed, and any tax liability owed by the deceased must be accounted for in the IHT 400 as a liability at the date of death. So as well as the inheritance tax and the deceased tax liability to the date of death, the executors must also deal with the tax for the administration period, which is the period beginning with the deceased death and ending with the date that the estate is distributed. Now, in most cases, any untaxed income and capital gains received during this period should be returned on a tax return. But in some cases, HMRC can agree the tax liabilities for this period informally in writing. But this won't be the case where the total tax and capital gains tax due for the administration period is more than £10,000, where the estate is worth more than 2.5 million at the date of death, or where the proceeds of assets sold in any one tax year are more than 500,000. So what tax are the executors liable for in the administration period? So they are chargeable to income tax at the basic rate of 20% or the dividend rate of 7.5%. And unlike individuals, there's no entitlement to the tax-free personal allowance. For capital gains tax purposes, any disposals made by the executors will need to be reported on the tax return. So to the extent that any assets have increased in value since the date of death, the executors will pay 20% on gain, unless it's a gain on residential property, which is taxed at 28%. And unlike the personal allowance, executors are entitled to a full capital gains annual exemption in the tax year of death and the following 2 tax years. And again, the normal filing and payment deadlines apply, being 31st of January following the end of the tax year. Finally, an executor should keep full records, not least because HMRC may ask questions, but also in case any claims are made against the estate in the future. And whilst it's not a tax obligation as such, an executor should also prepare an estate accounts for the administration period to demonstrate that they have administered the estate properly. Thank you for your time today.
Good afternoon. Welcome to the Money Matters presentation on group life assurance. The presentation looks at group life assurance, sometimes referred to as death in service, one of the most highly valued employee benefits, the difference between registered group life and accepted group life, and the importance of making sure the right scheme structure is in place. We will also look at nomination of beneficiary forms and the importance of completing them and keeping them up to date. Group life assurance provides a lump sum death benefit to beneficiaries in the event of death. The level of cover is usually a multiple of salary, although it can be a fixed amount. Importantly, the benefit is usually paid free of inheritance tax because it is payable at the discretion of the trustees, and the employee should nominate who they want the benefit to be paid to in the event of their death by completion of a nomination of beneficiary form. A level of cover is usually available without the employee having to provide any evidence of health. This is known as the free cover level, and the amount of free cover is mainly dependent on the number of employees covered. Free cover levels of up to £1 million are commonly available for even small to medium-sized businesses. The cost of cover will vary from company to company and is mainly determined by the industry and location, although it's typically less than 1% of payroll. The policies are provided by numerous insurance companies, including Aviva, Canada Life, and Legal & General. Employer premiums are a deductible expense for tax, and there is no P11D tax liability for employees. Moore Kingston Smith Financial Advisors can act as a broker to source the most competitive provider. There are 2 options to consider when it comes to establishing a group life scheme: registered or accepted. The majority of group life policies are set up under a registered trust. It is the most flexible type of trust as it can accommodate employees, insured for different levels of benefit within the same policy. It's also the simplest to understand, and no additional inheritance tax charges apply. A registered group life policy is subject to pension scheme tax rules, which means that any lump sum benefit paid in the event of death claim contributes towards the employer's pension lifetime allowance. The lifetime allowance was created when pension simplification was implemented back in April 2006. Benefits that count towards the lifetime allowance include registered pension schemes and lump sum death benefits from registered group life insurance schemes. For the current tax year, the lifetime allowance is £1.073 million, and it is planned to be increased by the Consumer Prices Index each year in the future. Benefits that exceed the lifetime allowance are subject to a charge of tax of 55% when taken as a lump sum. The tax charge is payable when the benefits are paid to the beneficiaries. Let's consider how this works in practice. A senior executive with a salary of £150,000, group life assurance under a registered group life scheme, a 4 times salary, £600,000, and a total pension fund of £1 million. In the event of their death, a tax charge of 55%, approximately £290,000 of the excess over the lifetime allowance would be payable. The alternative to registered group life is accepted group life, which is not subject to the pension scheme tax rules. This means that life insurance benefits in an accepted policy do not count towards the LTA, the lifetime allowance, but are subject to life insurance legislation. An accepted group life assurance scheme is not registered with HMRC. The arrangement comprises of 1, a trust, and 2, an accepted group life policy. The trustees will hold the accepted group life policy under a discretionary trust in order that any death benefits may be free from inheritance tax. Although note that the arrangement itself is not entirely free from the risk of inheritance tax. For example, a tax charge may arise on the payment of a death benefit if a tax charge arose at either the commencement date of the trust, which is unlikely, or at the 10-year anniversary immediately prior to the payment of the benefit. While accepted group life assurance arrangements can provide a suitable means of reward for those employees who are over or at nearing their lifetime allowance, they can have their pitfalls if appropriate advice is not taken. More Kingston Smith financial advisors can provide advice on whether a registered group life scheme, an accepted group life scheme, or a combination of both is the most suitable for individual situations. To finish on, I'll briefly look at nomination of beneficiaries. The trustees of a group life policy will pay any death benefits at their discretion, taking into account a range of potential beneficiaries. If the employee makes a nomination, the trustees will not be bound by this, but will take into account when deciding who to pay the benefits to. It is advisable to complete in all cases, but particularly relevant if circumstances are complex. The nomination form should be completed advising the percentage allocation to each beneficiaries and can be amended at any time prior to death. Many companies now have online nomination forms which make the process quick and simple. That concludes the presentation, which I trust you have found helpful.